There's a hidden pattern in the economy that most people ignore. It's not taught in schools. Financial advisors don't talk about it. The media glosses over it completely. But this pattern has predicted every major economic collapse for the past 200 years. And right now, it's pointing directly at 2026. This isn't some vague prediction or conspiracy theory. It's a pattern that's as predictable as the seasons. Winter follows autumn, and economic collapse follows economic boom, with mathematical certainty. The cycle we're talking about was first discovered by a Russian economist named Nikolai Kondratieff in the 1920 seconds. He analyzed economic data going back to the 1700s and found a remarkable pattern. This pattern forms long waves that repeat every 40 to 60 years. 4 distinct phases: spring, summer, autumn, and winter. Spring is the recovery phase after a major crisis. It's when economies rebuild, new technologies emerge, and debt is low. Summer follows, which is the boom phase: high employment, rising wages, and inflation. But then comes autumn, the plateau phase. It's when growth slows, inflation rises, and the economy begins to stagnate. Eventually, winter arrives, the crisis phase, where debts become unpayable, asset bubbles burst, and unemployment spikes. Kondratieff didn't just theorize about this. He documented it with decades of price data, interest rates, production statistics, and commodity prices. And the most important part, this cycle is not random. It's driven by technological innovation, debt accumulation, and the destruction of old economic structures to make way for new ones. Let me walk you through how it works. The Kondratieff Wave begins with spring. This is the recovery phase that follows a major economic crisis. After the storm clears, infrastructure gets rebuilt, new technologies emerge, and debt levels are low because the previous crisis has wiped out a lot of bad debt. Prices are stable, and optimism begins to grow. Although it's cautious, this is what happened after World War II. The 1950 seconds were a spring phase for the United States. America rebuilt its infrastructure, suburbs expanded, the interstate highway system was constructed, and television became mainstream. The economy grew, optimism grew, but inflation remained modest. Then comes summer, the boom phase. This is when the technologies introduced during spring mature and spread throughout the economy. Employment is high, wages rise, and inflation starts to increase as demand outpaces supply. Everyone feels wealthy, the stock market climbs steadily, and optimism reaches its peak. The 1960 seconds were a perfect example of summer. The space race took off, manufacturing was at its peak, and confidence in American prosperity seemed unshakable. The economy was growing, but debt was also rising. The seeds for the next phase were already being planted. Next, we enter autumn, the plateau phase. The peak of prosperity has been reached, but nobody wants to admit it. Growth slows down, inflation becomes a serious problem, and central banks start raising interest rates to fight inflation. This slows the economy even further. Asset prices start to become detached from their real value as people chase speculative investments. Debt continues to accumulate, as everyone believes that the boom will come back. This is where we are right now, in the 2020 seconds. We've reached the autumn phase. Debt is high, inflation is rising, and asset prices are soaring. People are becoming more and more speculative, but underneath it all, the economy is slowing down. And just like every cycle before it, we're heading toward winter. Winter is the crisis phase. This is when everything falls apart. The accumulated debt becomes unpayable. Asset bubbles burst. Banks fail. Unemployment spikes. A deflationary recession takes hold, wiping out everything in its path. This is the Great Reset, where all the excesses of the previous phases are purged from the system. Businesses that have survived on cheap credit go bankrupt, and over-leveraged investors lose everything. The only people who survive are those who prepared for winter. It's happened before. The Great Depression in the early 1930 seconds was a textbook example of the Kondratieff winter. Thousands of banks failed, unemployment hit 25%. The stock market fell by 89%. It took 25 years for stocks to recover to 1,929 levels. But here's the thing. The 2008 financial crisis should have been worse. It should have been a full Kondratieff winter, where everything would have been reset. But instead, governments and central banks intervened with unprecedented force. They bailed out the banks, dropped interest rates to zero, and printed trillions of dollars. What they did was delay the winter, not cancel it. And now, we're seeing the consequences. The winter that should have happened in 2008 is finally coming. The question is, are you prepared for it? The first thing you need to understand is that the timing of the Kondratieff wave is not random. It's based on specific cycles of debt, innovation, and economic growth. The original Kondratieff wave lasts about 50 to 60 years. The last major peak, the point where autumn transitioned into winter, happened in the late 1960 seconds and early 1970 seconds. Now add 50 to 60 years to that, and you get 2020 to 2030. We are now in that window. But there's more. The debt supercycle, which overlays the Kondratieff wave, has its own timing. The maximum debt saturation, where the system can no longer absorb more borrowing, happens roughly every 70 to 80 years. The last time this happened was during the 1930 seconds, at the height of the Great Depression. Add 70 to 80 years to that, and you get 2010 to 2020. We've already passed into the danger zone. There's another cycle at play here too, the generational cycle. Every 80 to 90 years, societies forget the lessons of the last major crisis. The people who lived through the Great Depression, who understood its causes and consequences, are gone. The current generation has no lived experience of economic collapse. This is one of the reasons why we're seeing the same mistakes being repeated. The last generational crisis peak was in 1929. Add 80 to 90 years, and you get 2019 to 2023. The timing couldn't be more precise. So now we have three major cycles, all pointing toward the same time period: the Kondratieff wave, the debt supercycle, and the generational cycle. Together, they suggest that the most likely flashpoint will be 2026. It's not just a theory. The evidence is all around us. Leading indicators, like the yield curve inversion, corporate credit spreads, and the velocity of money, are all signaling that a crisis is approaching. Let's take a look at these indicators. As we dive deeper into the economic signs pointing toward 2026, let's first look at one of the most reliable indicators, the yield curve inversion. A yield curve inversion happens when short-term interest rates rise above long-term rates. This creates an inverted curve on a graph. Historically, every recession since 1950 has been preceded by a yield curve inversion, no exceptions. In July 2022, the yield curve inverted for one of the longest periods in history. It stayed inverted for more than 2 years, signaling serious concerns about the future of the economy. The curve finally uninverted in September 2024, but history tells us that recessions usually follow within 6 to 18 months of the yield curve returning to normal. If we apply the same logic, this would mean that the recession could begin anywhere from March 2025 to March 2026. But here's where things get even more precise. The commercial real estate market provides another timing signal that is even more specific. There's approximately $1.5 trillion in commercial real estate loans that need to be refinanced between 2024 and 2027. These loans were issued when interest rates were between 2 to 3%, but now they'll be refinanced at 7 to 9%. These properties can't support the higher debt service, which means defaults will start cascading across the system. This refinancing cliff will hit its peak between 2025 and 2026, with the steepest part occurring in the first half of 2026. As these defaults spread, regional banks will begin to fail, triggering a credit freeze. When credit markets freeze, the broader economy collapses. It's the exact same scenario we saw in 2008, but this time, the global debt burden is much higher. We are living in an everything bubble, a term used to describe how every asset class, stocks, bonds, real estate, cryptocurrencies, even art, has been inflated simultaneously. Typically, bubbles occur in one sector. In 2008, real estate was the bubble. In 2000, it was technology stocks. But now, every major asset class is in a bubble. This is a unique problem. When everything is in a bubble, there's nowhere to hide when the bubble pops. Back in 2008, bonds were considered a safe haven. In 2000, real estate was seen as a safe investment. But now, with everything inflated at once, when the bubble bursts, it will affect all markets simultaneously. This is what makes the coming crisis in 2026 potentially worse than any previous Kondratieff winter. The correlation between all asset classes is unprecedented. Global debt reached $37 trillion in 2023, which is 340% of global GDP. In other words, the world owes 3.4 times its entire economic output. To put that in perspective, U.S. debt to GDP was 260% at the peak of the Great Depression in 1933. We're significantly higher now. Corporate debt in the United States is over $11 trillion, and a large portion of this debt is what's called zombie debt. These are loans to companies that can only afford to pay the interest on their debt, but not the principal. These companies survive only because interest rates were kept artificially low for more than a decade. As interest rates rise and stay elevated, these zombie companies will start to fail. When they fail, their lenders will take losses. And when lenders take losses, credit markets tighten. When credit tightens, healthy companies can't get financing. This triggers a cascading failure. At the same time, government debt is reaching unsustainable levels. The U.S. federal debt has reached $36 trillion, and annual interest payments exceed $1.2 trillion. That's more than the defense budget or Medicare. The single largest line item in the federal budget is interest on past borrowing. As long as interest rates remain low, this situation is manageable. But with the Federal Reserve's rapid rate hikes, interest payments on government debt are skyrocketing. Within 2 years, interest payments could exceed $2 trillion annually. In 5 years, this could consume 40% of all federal revenue. This is mathematically impossible to sustain. The government will have 3 options: default, which would destroy the currency and credibility; inflation, which would erode the value of money and savings; or austerity, which would cause a recession and social unrest. Historically, governments always choose inflation. It's the least visible way to reduce the real burden of debt. They simply print more money, creating inflation, and repay the debt with currency that is worth much less. This is exactly what happened during the last Kondratieff winter. The Federal Reserve is in a trap. If they keep rates high to fight inflation, they risk crashing the economy and triggering a wave of defaults. If they lower rates and print money, they risk reigniting inflation and destroying the currency. There is no easy way out. Central banks always choose to delay pain. They did it after the 2008 financial crisis, and they'll likely do it again in 2025. When they do, markets will rally, and people will think that the worst is over. But this will be the final bubble before the burst, the last gasp of artificial prosperity before the delayed winter hits in 2026. Let's take a moment to walk through the unfolding of this crisis based on historical Kondratieff winter patterns. The first phase is the crack. Something breaks. It could be a major bank failure. It could be a sovereign debt crisis in Europe. It could be a Chinese real estate collapse that spreads globally. Or it could be a series of corporate defaults that trigger panic in credit markets. What matters is this. After years of pressure, a crack will appear. This crack usually happens 6 to 12 months before the full crisis hits. Based on our timeline, the crack will likely appear between late 2025 and early 2026. When the crack appears, authorities will downplay it. They'll call it an isolated problem, something that won't have wider repercussions. They'll point to strong economic indicators and low unemployment. They'll say the fundamentals are sound. This is exactly what they said in 2007, when the first subprime lender failed. The second phase is the contagion. The crack spreads. If one bank fails, depositors at other banks get nervous. If a country defaults, investors start questioning the stability of other countries. If one sector of the economy is in trouble, lenders pull back from all borrowers. Fear spreads. Credit markets freeze. Companies can't borrow to make payroll. The economy grinds to a halt. This phase typically lasts 2 to 6 months, and in our timeline, it will occur between spring and early summer of 2026. In the third phase, intervention, governments and central banks panic. They do everything they can to stabilize the economy. Interest rates are cut to zero or even negative. Trillions are printed. Banks are bailed out. New lending programs are created. Fiscal stimulus floods the economy. For a time, markets stabilize, and people think the worst is over. But this is an illusion. The intervention doesn't solve the underlying problem. It only delays the inevitable. This phase can last anywhere from 3 to 12 months, and we expect it to run through the summer and fall of 2026. But by the fourth phase, the secondary collapse, people realize that the intervention didn't work. Markets that had rallied on the stimulus will begin to fall again, this time more rapidly and more deeply. Unemployment will rise sharply. Corporate bankruptcies will accelerate. Tax revenues will collapse, forcing governments to borrow even more just to maintain basic services. Social unrest will grow as people lose jobs, homes, and savings. This phase, the heart of the Kondratieff winter, typically lasts 18 to 36 months. In our timeline, we expect this to run from late 2026 through 2028. Finally, in the fifth phase, stabilization and reset, The economy will begin to recover. Bad debts will be liquidated. Zombie companies will fail. Asset prices will fall to levels supported by fundamentals, not speculation. The foundation for a new economic cycle will be laid. But this recovery will take time. It won't happen until 2029 or 2030 at the earliest. So, what does all this mean for you? How can you prepare for this impending economic collapse? The answer is simple. You need to act now. The Kondratieff winter isn't something that will happen overnight. It's a long-term process, but the window for preparation is closing quickly. Let's break down the key steps you need to take to ensure your financial survival as we head into the crisis. Step 1. Reduce your debt. Debt is the anchor that will drag you down when the crisis hits. The higher your debt load, the harder it will be to survive the winter. Look at what happened in the 2008 financial crisis. Many people lost everything because they were over-leveraged. They had too much mortgage debt, too many credit card balances, and too many loans. When the economy crashed, they couldn't keep up with the payments, and they lost everything. The same thing will happen again in 2026. If you're carrying a lot of consumer debt, high-interest loans, or credit card balances, now is the time to start paying them down. Focus on eliminating high-interest debt first. This is the kind of debt that will sink you when the economy goes into freefall. If you have a mortgage or student loans, see if you can refinance to a lower rate, or better yet, pay them down aggressively while you still have time. The key is to have as little debt as possible when the winter phase begins. If you wait until the crisis hits, you may find that you can't refinance or pay off your loans in time. Debt will become a crushing burden in the coming years. Step 2. Build cash reserves. During times of economic uncertainty, liquidity is everything. When the market crashes, you need cash on hand to weather the storm. Stocks and bonds will lose value. Real estate will take a hit. Gold, silver, and other hard assets will likely see price fluctuations, but having cash is the ultimate hedge against an economic collapse. Start saving aggressively now. Cut unnecessary expenses. Cancel subscriptions you don't use. Put aside as much money as possible into a high-yield savings account or money market account. These reserves will be crucial when the economic system begins to freeze up. They'll give you the flexibility to make the right moves when asset prices are low, and they'll keep you afloat if unemployment rises and wages fall. Step 3. Diversify your investments. When the crisis hits, traditional investments like stocks and bonds will likely plummet. This happened in 2008, when the stock market lost over 50% of its value in a matter of months. It will happen again, only this time, the economic conditions are even worse. Now is the time to diversify your investments. Start by looking at alternative assets that tend to do well during economic downturns. These include precious metals. Gold and silver are traditional safe havens during times of crisis. As paper currencies lose value, people flock to hard assets like gold. Farmland. Land is a tangible asset that holds value during recessions. As global food production becomes more volatile, owning agricultural land can be a profitable hedge against inflation. Energy. Energy-producing assets, such as oil and gas, may experience a resurgence in value during times of scarcity or geopolitical tensions. Businesses that provide essential services. These include things like water utilities, healthcare, and agriculture. When times get tough, people still need these basic services. The key to surviving winter is to shift your portfolio away from speculative assets and into those that will hold their value or increase in value during times of crisis. Don't just blindly follow the herd. Think about what will matter when the world around you starts to fall apart. Step 4. Invest in skills and knowledge. In addition to physical assets, one of the most valuable investments you can make is in your own skills and knowledge. When the economy crashes, many people will find themselves out of work, and it will be harder to get a new job. But people who have valuable skills will always be in demand. Think about skills that will always be relevant, things like healthcare. Doctors, nurses, and other healthcare professionals will be in high demand, especially in the aftermath of a crisis. Technology. While the economy might crash, technology will continue to evolve. Coding, cybersecurity, and IT skills are highly transferable and recession-resistant. Trade skills. Electricians, plumbers, and other tradespeople will always be needed, even in hard times. Learn a practical skill that people will always need. Financial literacy. Knowing how to manage money, understand investments, and make smart financial decisions will help you thrive during difficult times. Don't just focus on survival. Focus on thriving in the winter. The people who come out of this stronger will be the ones who have invested in themselves and their ability to adapt. Step 5. Stay mentally and emotionally prepared. Preparing for the Kondratieff winter isn't just about your finances, it's about your mindset. The collapse of the economy can take a heavy toll on people's mental health. Uncertainty, fear, and anxiety will be prevalent. Many people will panic, and some will even make rash decisions that ruin their financial futures. You need to prepare mentally for the storm. This means staying calm. In a crisis, people often act impulsively. Stay calm and keep a level head. If you've prepared financially, you'll have the advantage when everyone else is freaking out. Resilience. Understand that hardship will come, but it will pass. Resilience is key. The ability to endure tough times and come out the other side stronger is one of the greatest assets you can have. Optimism. The winter will be tough, but it's not the end of the world. Remember that after every Kondratieff, winter comes a new spring. There will be new opportunities to build wealth and start fresh. If you've prepared, you'll be in a better position to seize those opportunities when they arise. As we move into the final stretch before the 2026 crisis unfolds, it's critical to understand one last thing. The winter phase is not a random event. It is a cycle, and it will reset everything, but it will also create enormous opportunities. These opportunities won't be easy to see at first, and they certainly won't be easy to grasp in the midst of chaos. But those who are prepared will be able to turn the crisis into a springboard for future prosperity. The hidden opportunity in crisis. In every Kondratieff winter, there are two groups of people, those who survive and those who don't. Those who don't survive are the ones who get caught up in the panic. They're the ones who sell their assets at the bottom, take out loans to survive, and watch their wealth evaporate. They didn't see the warning signs. They weren't prepared. But then there are the survivors. The survivors are the ones who understand that the crisis is a natural part of the cycle. They know that after winter, spring always comes again. When the economy crashes, these people buy up assets at rock-bottom prices. They invest in companies that are on the verge of greatness. They acquire land, real estate, and other valuable assets that others are selling in desperation. They position themselves to thrive when the recovery begins. What will the world look like after the winter? While it's impossible to predict every twist and turn, there are a few things we can be certain of. New technologies will emerge. Every major technological breakthrough happens during a recovery phase. After the chaos of the crash, new industries will emerge. Think about how the internet changed everything after the dot-com crash, or how clean energy will transform the economy in the coming decades. The world will need new solutions, and if you're positioned correctly, you can be part of the next wave of innovation, the rise of new leaders. The people who understand what's happening and are prepared will be the new leaders. They will lead businesses, communities, and governments out of the crisis. Their financial strength and resilience will give them the power to shape the future. A major shift in global power, economies will be restructured, and countries that have been propped up by debt may fall into turmoil. This could lead to shifts in global power dynamics. Some countries will emerge as economic superpowers, while others will struggle to maintain their footing. The rebuilding of trust. Trust in institutions will be shattered. People will stop relying on banks, governments, and the media. This will create opportunities for people and organizations that are trustworthy, authentic, and capable of rebuilding that lost trust. The importance of flexibility and adaptability. Flexibility will be key during this period of transition. The people who are prepared financially but remain rigid in their thinking will struggle. They may have the money to survive the crisis, but they won't have the adaptability to thrive in the new world that will emerge. So, what does adaptability look like? It's being able to adjust your approach to investments, business models, and lifestyle according to the changing economic landscape. If you've built a portfolio of stocks and bonds and the market crashes, you'll need to be flexible enough to shift into assets like precious metals, farmland, or even private businesses that will hold value during the crisis. If you've built your wealth through real estate and the housing market crashes, you need to be ready to pivot and look for opportunities in new sectors like tech or healthcare. Adapting your mindset to these changes will be just as important as adjusting your financial strategies. Those who hold on to outdated models of success will fail, while those who embrace change and learn to ride the new waves will prosper. How to position yourself for long-term success. We've discussed how to prepare for the initial crash, reducing debt, building cash reserves, and diversifying investments. But what about after the crash? What happens when the dust settles and we start rebuilding? To position yourself for long-term success, here are a few things you can do. Focus on sustainable industries. After the crisis, there will be a huge demand for businesses and industries that focus on sustainability. Whether it's renewable energy, healthcare, or sustainable agriculture, these sectors will thrive in the aftermath of the crisis. The businesses that lead the charge in these areas will become dominant players in the new economy. Invest in human capital. The most valuable asset you can own isn't land, stocks, or real estate, it's your mind. Investing in yourself through education, skills development, and personal growth will make you far more resilient in the face of any economic storm. Learn new skills that are in demand, especially in fields like technology, data analysis, and healthcare. Prepare for volatility. In the aftermath of a crisis, the economy won't recover overnight. There will be periods of extreme volatility. It's essential to stay calm and ride out the storms. If you're prepared and have a diversified portfolio, you'll be able to weather these periods of uncertainty and emerge stronger when the market stabilizes. Start a business. Entrepreneurs thrive during times of crisis. They find gaps in the market and create new solutions for people who are struggling. If you've ever thought about starting a business, this could be the perfect time to take the plunge. Start small, focus on providing value, and be adaptable as the market shifts. Build a network of like-minded people. The value of a strong, supportive community cannot be overstated. Surround yourself with people who share your values, who understand the importance of preparation, and who are committed to helping each other survive and thrive during difficult times. Your network will be one of your greatest assets as you navigate the future. Be patient. Success during and after the winter phase won't happen overnight. It will take time to rebuild and adapt. But if you've prepared, if you've diversified your investments, and if you've positioned yourself in the right industries, you will be in a far better position than those who waited too long to act. Now, we come to the most important part of this entire conversation. You've heard the warning signs. You've learned the steps to prepare. The winter is coming, but there's still time to act. You don't have to wait until 2026 to start making changes. Start today. Reduce your debt. Build your cash reserves. Diversify your investments into sustainable, recession-proof assets. Focus on developing valuable skills. Surround yourself with like-minded people who are also preparing for the future. In the next few years, we'll see a massive shift in the global economy. Some people will panic and lose everything. Others will thrive and come out of this crisis wealthier than they ever imagined. Which group will you be in? The choice is yours.